Welcome to the video. First, we are going to define what an excess Roth IRA contribution is, why it happens when your income surges, and why acting quickly matters. Then we will walk through the official IRS-compliant fix, the recharacterization, and the advanced backdoor Roth move for high earners. Finally, we will flag the pro-rata trap so you can avoid unexpected taxes. Before we begin, a quick disclaimer. This video is educational in nature and does not constitute financial, tax, or legal advice. Your situation is unique, and tax rules can change or be applied differently based on your details. Please consult a qualified tax professional or financial advisor before implementing any strategy discussed here. Next, here is our agenda. We will start with why excess Roth contributions happen. Then, we will cover the official IRS fix called Recharacterization. After that, we will show the backdoor Roth technique designed for high earners. We will also explain the pro-rata rule and how to avoid it, followed by timelines, forms, and action steps. Finally, we will test your understanding with a couple of quick quizzes. First, let's define the problem. An excess Roth contribution occurs when your modified adjusted gross income, or MAGI, ends up above the annual limit after you have already contributed to a Roth IRA. If this isn't corrected, the IRS can assess a 6% excise tax on the excess amount for each year it remains. The good news is that selling your investments is not required to fix this. The IRS has an official correction method. The key is to move quickly and work with your IRA custodian to ensure the paperwork is properly handled by the appropriate deadlines, typically the tax filing deadline, including extensions. Now let's visualize the decision path. The flow begins with whether a Roth contribution was made. Next, we compare your MAGI to the annual IRS limit. If you are within the limit, you keep the contribution as Roth. If you are above the limit, you request a recharacterization to a traditional IRA. After recharacterization, you may consider a backdoor Roth conversion. Before converting, you must check whether you have any pre-tax balances in traditional, SEP, or simple IRAs. If you do, the pro-rata rule will apply to the conversion, which can trigger taxes. In that case, consider rolling pre-tax IRA funds into an employer plan, such as a 401k before conversion. If there are no pre-tax IRA balances, you can proceed with converting the full recharacterized amount back to a Roth IRA. Then, let's handle the fix. Contact your IRA custodian and request a Roth IRA contribution recharacterization. Provide the tax year and the precise dollar amount to recharacterize. Confirm that the destination is your traditional IRA at the same custodian. Understand that any earnings or losses attributed to that contribution must move along with the principal, as required by IRS rules. Complete the custodian's forms and clarify the processing timeline. Ask how they will report the transaction on Forms 1099-R and 5498, since these forms document the recharacterization for the IRS. Keep all confirmations in your records. Finally, plan for a potential backdoor Roth conversion only after you have checked whether the pro-rata rule would apply. Next, here are the 2024 Roth IRA income thresholds. For single or head of household filers, the full contribution is allowed below $146,000, with a phase-out between $146,000 and $161,000, and no direct contribution above $161,000. For married filing jointly, the full contribution is allowed below $230,000, with a phase-out between $230,000 and $240,000, and no direct contribution above $240,000. For married filing separately, if you lived with your spouse, the phase-out generally runs from $0 to $10,000, which effectively disqualifies most from direct contributions at modest income levels. Always check the current year's IRS limits, as these figures adjust over time. Moving forward, let's describe the backdoor Roth sequence. First, you recharacterize the excess Roth contribution into a traditional IRA. That amount becomes non-deductible basis in the traditional IRA. Second, verify that you do not have other pre-tax IRA balances, because those would trigger the pro-rata rule during conversion. Third, once you confirm you have a clean slate, convert the entire traditional IRA balance back into a Roth IRA. Your custodian will issue Forms 1099-R and 5498 documenting the recharacterization and conversion. On your tax return, you will use Form 8606 to report the non-deductible basis and the Roth conversion. Many people perform the conversion soon after recharacterization to minimize gains or losses on the basis amount. Meanwhile, consider your two common choices: recharacterizing versus withdrawing the excess. Recharacterizing is the IRS-approved fix that retroactively treats the money as contributed to a traditional IRA. It automatically moves any earnings or losses, and it keeps the path open for a backdoor Roth conversion later. Reporting is straightforward with the custodian's Forms 1099-R and 5498 plus Form 8606 on your return. By contrast, withdrawing the excess requires removing both the excess and any associated earnings. That demands careful calculations and may result in an excise tax if not handled on time. It also shuts down the easy path to a Roth via the backdoor method and increases the risk of paperwork errors. Next, let's focus on the pro-rata rule. When you convert to a Roth IRA, the IRS looks at all of your traditional, SEP, and simple IRAs combined. Only the percentage equal to your after-tax basis is tax-free, and the remainder is taxable income. To avoid this, many people pursue a clean slate by rolling any pre-tax IRA balances into an employer plan, such as a 401k, before the end of the year. The pro-rata calculation is based on your aggregated IRA balances as of December 31st. For example, if you have $95,000 of pre-tax money and $5,000 of after-tax basis, only 5% of any conversion is tax-free, while 95% is taxable. That is why addressing pre-tax balances before converting is critical. To visualize the pro-rata effect, imagine a conversion composed of 5% after-tax basis and 95% pre-tax funds. The pie chart highlights that only a small slice is tax-free, while the majority is taxable. This graphic reinforces why rolling pre-tax balances into a qualified employer plan before a backdoor conversion can help you avoid unexpected taxes. Quick knowledge check. By when must a recharacterization of an excess Roth contribution generally be completed to avoid ongoing 6% excise taxes? Option A. By December 31st of the contribution year. Option B. By the tax filing deadline for that year, including extensions. Option C. Any time within 3 years. Option D. Only before you file your return, with no extensions allowed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is by the tax filing deadline for that year, including extensions. This timing helps you avoid ongoing excise taxes. Always verify current IRS rules for the specific year you are correcting. Second quiz. Which action helps you avoid the pro-rata rule when using the backdoor Roth strategy? Option A. Converting only part of the traditional IRA. Option B. Rolling pre-tax IRA balances into an employer 401k before conversion. Option C. Leaving pre-tax and after-tax dollars together in your IRA. Option D. Waiting until next year to convert. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is rolling pre-tax IRA balances into an employer 401k before conversion. Doing so can remove those pre-tax IRA dollars from the pro-rata calculation, allowing your backdoor Roth conversion to be largely or entirely composed of after-tax basis. Next, let's put this into a practical checklist. First, confirm your MAGI and determine the exact excess amount. Second, request the recharacterization with your custodian and note their processing timelines. Third, track the tax forms they will issue, including Forms 1099-R and 5498. Fourth, prepare to file Form 8606 to report your non-deductible basis and any Roth conversion. Fifth, verify that you have no pre-tax IRA balances as of December 31st before converting. Sixth, if necessary, roll pre-tax IRA funds into a 401k or similar employer plan. Finally, execute your backdoor conversion and save all confirmations and statements for your records. To connect the steps over time, the timeline shows the contribution early in the year, an unexpected income surge that causes the excess, and a recharacterization requested before the tax filing deadline, including possible extensions. It then highlights rolling any pre-tax IRA balances into a 401k before December 31st, performing the backdoor Roth conversion shortly after recharacterization, receiving Forms 1099-R and 5498 the following year, and filing Form 8606 with your tax return. To recap the essentials. First, recharacterization is the official fix and does not require you to sell investments. Second, the backdoor Roth process can help high earners regain Roth benefits. Third, avoid the pro-rata trap by moving pre-tax IRA balances into an employer plan before converting. Fourth, respect the deadlines, generally the tax filing date with extensions. Fifth, keep thorough documentation, including confirmations and required tax forms. In summary, if you have an excess Roth contribution, do not panic. Correct it with a recharacterization through your custodian when you are ready, and only after addressing any pre-tax IRA balances. Consider the backdoor Roth conversion to maintain Roth benefits as a high earner. Stay on schedule, document everything, and confirm details with your custodian and tax professional. Finally, thank you for watching. If this video helped, please like, share, and subscribe for more practical tax and investing guidance. We would love to hear your experience with recharacterizations and backdoor Roths, so share your thoughts and questions in the comments below.